Hello again, this is Dr. Mahmoud Al-Odeh, and this is the last video for chapter 5 on the annual worth analysis. In this video, I will be talking about the calculation for the annual worth analysis for infinite or long life alternatives. The annual worth for infinite or long life alternatives can be calculated by finding the annual worth of the capitalized cost of the alternatives. If you remember in the previous chapter, we did discuss the capitalized cost, and if you remember, the capitalized cost is equal this equation that we used. We use the annual worth divided by the interest rate. Now what we're going to do, we're going to find the annual worth, and what we do to find the annual worth, we multiply the capitalized cost by I. So whenever we see the capitalized cost, whenever we see a present value, remember this is a PV, this is a present value, a number in a present format, we multiply it by I to find the annual worth for infinite projects. So, as we discussed in the previous chapter, these long projects, infinity projects, these typically are government projects such as building hospitals, parks, roadways, bridges, etc. All right, so how we do this calculation? First of all, what you need to do, this slide will summarize the 4 steps that you need to go through to be able to do the annual worth analysis. Step number one, cash flows that occur at the regular intervals should be converted to annual worth for one life cycle. So for example, if I want to do 5 years, it has to be converted into the annual worth for only one period. And using the PMT rate, X years, the number of years, comma, and another comma, and the cost every X years. Then the second step, cash flow that happens once, such as the initial cost, should be converted to its present value and then multiplied by the interest rate to obtain the annual worth value over infinity. And this is reminder, this is what we used from previous chapter. Annual worth equal the capitalized cost times I, and the capitalized cost is the same thing as the present worth. And this is how you do for the only transaction that happened once, and most likely that's going to be for the initial cost. And number three, if there's any annual cost that it should be used as is, there's no need to multiply it by anything. And then the last step is adding all these together. These are excellent, but let's go ahead and apply what we've learned, these steps, into this example. Example number 5, find the annual worth for the city park that will be built in northern Minnesota for $2 million. Annual maintenance is $2,500 per year with a major refresh required for $15,000 every 5 years. Assume the interest rate is 5%. So what we do here, we have 3 numbers. So we have this 2 million right here. This is number one, and this is the initial cost. This is in a present format. All right, so I'm gonna say P here. 2,500 per year. This is in what format is this? Can you tell? This is in the A format. And this is a major refresh, would be in every 5 years. This is, what format is this number? This is in the future, every 5 years. So while you look here, once you see there are 3 numbers that we need to deal with, one of them is in the A format. So this is the number that you don't want to do anything with it. The 2 million, we need to convert it into the annual worth. How we do this? We multiply it by the interest rate. So this part will convert the 2 million into the annual worth by multiplying by 5%, and make sure to have the negative sign right there. And this is the second number is 2,500. This is going to be the same, no multiplication by anything. And the third number, the 15,000, should be converted into the annual worth by multiplying that by using the PMT function, 5% for every 5 years and this is a future value negative 15,000, and that would give you an annual worth of $105,214. All right, so I'm gonna switch to show you how to use Excel for this. So we're going to do share Excel. Where's the Excel sheet? All right, so that's the Excel sheet. We are on example number 5. All right, so so as you see, this is the question. What we did here, as you see, I like to summarize my question in symbols. So I have three rows. One for the initial cost, 2 million. Another one, annual work for maintenance and operational cost, and 15,000 for every 5 years. So what we need to do, we need to convert these into annual worth. So started with a team 2 million. We used this we converted into annual worth by multiplying that by the interest rate. So that would be 100,000. Annual maintenance and operational cost, still the same. Make sure to have the negative sign. Make sure that this is a cost. And future value, future cost every 5 years. We use the PMT function for 5%, 5 years. And now what you need to do is add these together to find the annual worth for this project to be 105,214. All right, let's take another example, which is example number 6. Example number 6 basically will also help you understand the whole annual worth and will be considered as a review for the previous concepts for multiple alternatives uh, and also for the infinity. Okay, example number 6, the owner of a manufacturing company based in St. Paul, Minnesota, is looking to add an additional assembly line to expand his market share. There are 3 options to consider for establishing the new line. Information about these options are summarized in the following table. If the market interest rate is 5%, and use the annual worth analysis to choose the best alternative. Yeah, so we have these information: initial cost, maintenance and operational cost per year, maintenance and operational cost every 10 years, salvage value, and the lifetime for these projects. How we could conduct the analysis. Let's switch to Excel now. All right, so in Excel, what we did here, uh, and again, if you see the video number 1 of this chapter, you'll see there are 2 methods for conducting the annual worth analysis. One is to build the cash flow table, and the other one is just step by step and converting only the numbers that we need. So what I did find the cash flow table as a way for me, easier for me. I want you to get used to this concept, building a cash flow table. So I built a cash flow table for alternative A and alternative C. All right, so here's the question. I'm going to just put it here on the screen as well, so you could see the numbers. Initial cost for alternative A is 100,000, and as you see, there's a maintenance and operational cost 15,000 every year from year 1 all the way to 5. And on the year 6, we will collect the salvage value. So now we have a cash flow table. We could go ahead and apply the NPV function 5%, and select all these numbers from year 1 to year 6. Add to that year 0, which is the initial cost. And now what we do convert this number, the 161,000, to the annual work format using the PMT function, 5%, 6 years, and we use that number 31,761. And then we do the same thing for alternative C. Both of them will last for 6 years, 80,000 for C, and then 20,000 the maintenance and operational cost per year. As you see, this has happened every year. Year 6 is where you include the salvage value of plus $30,000, and that will give you a net cash flow for year 6 of $10,000. Now you use the NPV function, 5%, select all these values from 1 to 6, add to that year zero, and then uh, find the present worth for that alternative. And the last thing that we lifted to the end, which is the the annual worth for alternative B. So as you see, alternative B, we have the 130,000, 15,000, and 50,000, also the 80,000. However, the 80,000 is not used here because it's a salvage value, so you don't use it. You're not going to collect this money. This is going to happen forever. It's an unlimited life for this alternative. So you're not going to connect. You're not going to collect that money. This money is just given there for additional information, the unneeded information. So we're going to deal with the 130,000, 15,000, 50,000. So for the 130,000, this is a present format. We multiply it by 5%, as you see here. We multiply it by 5%. And then the 15,000, it is already in the annual format. We use it as is. Now for the cost that happen every 10 years, we need to use the PMT function because this is a future value number. So we need to use 5%, 10 years, and $50,000. And that will give you a 25,000. And therefore, now we have to write a short sentence saying which alternative we should select. And alternative B, as you see, it has the highest annual worth, and therefore we should select alternative B. As you see, this is the least expensive, um, alternative. All right, well, I hope this is helpful. Please let me know if you have any question. There are more videos on the problems itself, so please review these videos from YouTube channel. Thank you so much, and again, I hope this is helpful.